This panel is on private equity and venture capital exits in India. Let me introduce you to our moderator. He is an investment manager at Kohler Capital, based in the firm's London office. Please welcome Mr. Kutti Datta, investment manager, Kohler Capital. Our first panelist has been an active venture investor in India over the last 11 years and has successfully invested in, please welcome Mr. Vikram Godse, Director, Mayfield India Fund. Our next panelist is a managing director with Sequoia Capital India. Please welcome Mr. G.V. Ravishankar, Managing Director, Sequoia Capital India. Our final panelist is the Managing Director for Zephyr Peacock India Management. Here he is, Mr. Mukul Gulati, Managing Director, Zephyr Peacock India. And now I hand the floor over to Mr. Kutti, who will take us through the next 1 hour.
Thank you very much. Thanks for asking us to discuss what we think is an important and relevant topic. Before we start, I'd just like to ask my panelists to very quickly just introduce their firm and more importantly, just talk very quickly about the vintage of their current fund and where it is in its life cycle in terms of exits.
Hi. So Mayfield's been around for the last 43 years as a tech investor, early stage tech investor in the US and China. Our India fund is a 2009 vintage early stage venture firm. We don't just focus on just technology, we do non-technology and technology. There are 2 partners on the ground, a team of 5 looking at a portfolio that's almost 60% invested. The fund is almost 60% invested, and we've already had exit events. We've returned almost 70% of the fund so far.
Hi, I'm GV. Sequoia Capital in India manages about $1.4 billion across 3 funds. These are 2006, 7, and 8 funds. 2 are growth funds and one is a venture fund. The 2006 growth fund is a $400 million fund, which is 70% distributed, and there'll be more liquidity this year. 2007 venture fund is in its 5th year, 4th year in the investing cycle as we started that one. We've seen some liquidity there, but still early days. In 2008 is a youngish fund which started its investing life in 2009 from a growth perspective, so that's still very early. From our perspective, we have seen from both Growth Fund 1 and, as you guys know, the history of Westbridge Capital, which had 2 earlier funds as well, seen our share of IPOs and exits, and happy to discuss some of those.
Hi, I'm Mukul. I'm with Zephyr Management. Zephyr is based in New York. We are a global emerging markets focused asset manager. We manage about $1 billion across the globe in private equity in Africa and in India, and in listed securities across the emerging markets. In India, we've been investing since 2006-2007, but the bulk of our investing has occurred between 2009 to 2011, since we started out with our own prop fund early, in the early part of our business in India.
Thank you. Before we sort of dive into sort of the different types of exits, I think what we do is we try and just set the scene a little bit in terms of the exit environment and what's really driving it. So why don't we kick off with that? So I guess what we're trying to really decide here is what's driving the need for exits. I mean, is it GP-led, is it LP-led, or is it both? Are GPs properly aligned and incentivized to drive for exits, or do we have too many guys focusing on investing, making deals, and fundraising in our industry? Maybe I'll start with Vikram on that.
Sure. I think the key word is alignment. As long as you've got core alignment between LPs and GPs, you will see behavior that's beneficial for both. One of the things you mentioned is are GPs exiting purely so that they can move on to fund 2. I think the real question to be asked there is what is driving that. And if there are a lot of LPs saying that they need to see an exit before you come back to the market, that behavior is not aligned, and it's being driven by the LP community again. So what I would say is, in the larger context, if you have GPs and LPs aligned on size of funds, returns being made only out of carry, or rather a substantial portion of the returns being out of carry, you will see behavior that's far more conducive for both to benefit.
I heard from a GP recently that when they have an LP in their fund who is definitely not going to come into their next fund. They're going to push for those exits from the current fund. On the other hand, if they are definitely coming into the next fund, they'll say, keep them back and make sure you get the full multiple play. So how do you deal with that conflict when you have conflicting pressures from LPs applying sort of different kinds of pressures on a GP to exit or not to exit?
Sure. I think it boils down to how many LPs and how many of them want you to exit earlier and how many of their interests are diverse from yours or the larger community. So it really goes back to, going back, if you have an advisory board or if you have a bunch of LPs who all are saying, you need to exit something early or give us liquidity early, then so be it. Those are your clients. As a GP, that's what I would think. But if a large portion of them are saying, no, wait a minute, let's have patience. Let's make sure we are going the whole hog, getting the right kind of returns on a particular deal or a bunch of deals, then I think you can always push back that one LP saying, wait a minute, this is not exactly the sentiment voiced by all the other LPs in the fund.
I guess one thing to add, mid last year we did a tour of meeting all the LPs, and one of the things that's interesting is if you as a firm have earned their respect over a period of time as to someone who will do the right thing for them, then the desire to push in a certain direction from them is lower, because theoretically the GPs are closest to the investments, right? So they're supposed to know what the right time to exit an investment is. So there's no point having some artificial pressure on them to distribute. Having said that, one of the things we picked up was during the whole Lehman crisis and beyond, most LPs kind of were stuck with no liquidity. They are not planned for an event like that. They couldn't get the liquidity they were seeking, and that's kind of given them some shock, and hence most of them are curious about how to plan for their liquidity events for their own purpose, be it charitable or infrastructure building or whatever, and they would like to see some liquidity. So they're looking up to you to say, what can we expect this year, and what are you promising to us? But yes, for the first-time funds who are keen to kind of demonstrate exits, there is a pressure on themselves to kind of go show something before they go and ask for the next fund. But theoretically, it should be the GP's call. Hopefully, if they're doing the right thing in the interest of their client, then this shouldn't be an issue.
Okay, are there other ways to sort of get GPs focused on exits? Are we too focused on the 2 and 20 carry structure? Is there maybe a line-by-line model that works better, or is there some other sort of mechanism by which we can incentivize GPs to push for exits, perhaps a higher hurdle rate? Any thoughts?
I think the 2 and 20 is maybe the least worst of all structures. I've known of firms that have line-by-line carried interest, and I think that distorts incentives and forces the investment team to work in a way that's not fully aligned with all LPs. And I agree with GV that ultimately the GP has to be mature enough to collectively or singularly decide for all other LPs. We had a situation in 2008, early 2009, where there was a fair bit of pressure for liquidity and from our LPs, not all, but some of them. And we explained to them that if we sell these assets now, we will get less than half of what we believe is their intrinsic value. And so we held on for a few more months, and the markets turned around and we got a better price. And I think in the long run that was the right decision for everyone. So I think that the GP ultimately has to make a decision based on the collective interest of all LPs, and not get so influenced by the individual liquidity needs of individual limited partners.
Okay, moving on to a sort of related area, a recent sort of VC Circle survey, I think 66% of GPs said that they hope to deliver an IRR of over 25% this year and going forwards. Given what we've seen before, especially over the last year, and what we heard from the KPMG report yesterday, and also taking into account the fact that the funds that are going to be exiting this year, the year after and the year after, are funds that are invested in the periods of 2006 to 2008, which many believe to be poor investment vintages. Is this even a realistic returns expectation? Do PE firms have to lower their return expectations in order to achieve these kind of exits? And I guess ultimately what we're trying to dig down to is whether there's some kind of inherent trade-off between shooting for multiple or shooting for IRR. GV, could you comment on that?
It's just purely from a 2006 vintage fund, and we have one of those, it's purely a function of really how aggressively did you invest in that period. If you had invested aggressively in 2006 and 2007 and didn't have enough to invest during the downturn, then likely the 25% IRR is not going to be easy for most people who did that. In terms of just the trade-off between holding for a multiple versus IRR, I mean, your clients are finally measuring you and the asset class, on that basis of IRRs because they have the choices that they can make. The argument potentially could be the GP benefits from a bigger absolute return from a carry perspective, but I guess finally you are working for your clients, that's the most important thing. Is the 25% IRR and the surveys saying, this year 25% IRR realistic? I think that will be a wide range. My view is on an aggregate 2006 funds will find it hard to deliver those kinds of returns at an overall basis.
I guess the returns expectations will also, from an LP standpoint, would be different for the different buckets. You've got the venture guys, then you've got the buyouts, you've got growth equity, etc. So I would have to agree with GV. The 25% IRR across the board does look difficult. It's not going to be easy for a lot of people to deliver that. Having said that, second part of your question, a lot of the LPs, at least on the venture segment, are very focused on the number of X's you return of the fund. And I would say the expectation still remains people make about 2.5x at least on their fund, at a fund level. It's not going to be easy, but that's the expectations out there.
I think for investments that were made from 2006, 2002, 2008, on the aggregate, I think it's highly unlikely that we will get anywhere close to the 25% IRRs. And the main reason is capital markets. Whether we like it or not, our returns are highly correlated to what's happening in the equity markets. The Sensex today is exactly at the level it was in November or December of 2007. In this kind of environment, to expect those returns, very difficult. There are two other factors that are complicating that. There was early crazy days of Indian private equity. Multiples were high. There was a reverse arbitrage between the equity markets, the capital markets, and the private markets. So you're paying higher multiples. And then third, because the industry was young, there wasn't enough focus on value addition, on strengthening management teams or realizing operating efficiencies. So as a whole, collectively, the private equity industry in India, in my opinion, did not add value. You combine those three, and I think that you should expect underperformance, and which is what the KPMG data is illustrating. However, I feel differently about, it's my prediction, I may be wrong, about 2009 onwards.
I would have to agree with that. Don't let me interrupt you.
Sorry. So if you look at the investment vintages for the last 3 years, where multiples have come down, economic growth has slowed down from 9% to 7%, but you still have businesses that may be growing anywhere from 20 to 50% a year. And I think managers, private equity managers, have matured. So I think investors over the next cycle will have, should expect and realize better outcomes.
Thank you. I think maybe what we do now is turn a little bit to sort of the different types of exits that we've seen from funds, and perhaps we'll focus on the funds with each GP that's had success with a particular strategy. Perhaps we start with you, Mukul, again. IPOs have historically been a large source of exits in India, and I guess the market was largely shut over the last year or so. To what extent do you see the IPO market returning, going forward this year and in the following year? And what's going to drive this? And is it going to be domestic funds, domestic retail demand, or FII flows?
So I'm not a stock market guy, but based on what I read, it appears for the last 5-6 years, foreign institutional investors are the most important drivers of trading volumes and valuations in the Indian equity markets. Unfortunately, our domestic institutional market is not active, and for the most part acts at the behest of the government of India. In fact, domestic retail market is more important. Domestic retail investors are more important to the Indian equity markets than domestic institutional investors. So, and that segment of the market, as you would all guess, is highly emotional. And they invest at the worst times, and the market's peaking, they put money in, and when the market goes down, they pull. They invest when the market peaks, and when they should be buying, they start selling. And so really, unfortunately, this is true for the Indian stock market, and generally, even for long-term capital needs of India, that we are highly dependent on foreign investment in this country. And the main reason for that is that we don't have good asset intermediation where Indian savings are not coming into capital markets. They're sitting in gold or real estate or bank deposits. And less than 5% of Indian savings are going into equity markets. The unfortunate outcome of that is that we are dependent on foreign institutional investors who in turn are dependent on the global mood. So yes, I'm hopeful that in the next 12 to 24 months, Indian equity markets will perform strongly, but it will depend on how the global economy does.
Well, maybe if you could just talk about perhaps one of your exits, and really in the context of sort of talking about sort of post-listing exit strategy and how you really exit from an investment post-IPO, lockups permitting and so on. How does one really exit from a thinly traded public company, with the promoter still retaining a large portion of the equity?
This is a relevant issue in India for various reasons. Many times funds are locked up. We were locked up in one of our IPOs. Second reason is that IPOs in the past had happened pretty quickly after the private equity investment. So the kind of earnings expansion that you were hoping for in your investment horizon, you have not realized at the time of the IPO, and you believe in the business model and the management, so you want to hang on post-listing, which sometimes doesn't sit well with LPs because the classic private equity model in the West is that once you list, you get out. In India, you may not want to do that because you may not have realized full potential, and at least in the mid-cap segment of the Indian equity markets, there's a high level of inefficiency where private equity-like approaches can work in a listed environment. So if you do not believe that the market is giving you a fair price, then you should hang on. Now you talk about the challenge that you raised, that if the stock is not traded, yes, then you have a problem. In the past, we ourselves, and not only in India but also in Africa, we've been able to overcome that by creating institutional awareness, for our security, and personally been involved in selling the story to institutional investors, to whom we've been able to do a block sale with. But it's not easy. But over the medium to long term, if you have a strong fundamental story, either the stock will get liquid enough, or you will find someone who will do a block sale and take your share of it.
So I want to add to that, and share our experience. Clearly, IPOs are milestones in the life of a company. I mean, it's hard to see them as exit events all the time, for the reason that in India you can go IPO with 30-40 crores of PAT, and that's not a big company. And when you think about companies like that, and there have been companies where we were investors in a company called Manapuram earlier, and at that time when we bought into this company, it was already a listed company for more than 10 years, but it was a quasi-private company. It was really not a public company, almost no volumes, and it was a negotiated transaction where we had a board seat and some kind of rights to help channel the business. And in that particular case, this was a company that had like 13 crores of trailing PAT and projecting some 25 crores. Today has, as of the first 3 quarters, has 450 crores of PAT in the last 4 years. And what tends to happen is you got to work with these companies just like how you work with a private company, and have a fairly long-term horizon as to how you're looking to exit these situations, and then work, like you said, with them, kind of explaining this whole thing to the markets, getting them to understand what this company is all about, what the business model is. We had to do a lot to kind of get them to a place where they would be covered by a few reputed brokerages, and then they did a follow-on QIP, which created the liquidity post which we exited because the valuations had gone to a stage where it was lucrative to exit. So you got to work with them just like how you would prepare a private company for an IPO and get ready for the markets.
I mean, putting you on the spot a little bit here, I mean, if you could come up with a sort of an average hold period post-IPO for a listed company, what number would you put on it? I mean, if you think about your typical sort of private equity hold period is say 5 years, and obviously there's a range around that. What would you say is the average hold period post-IPO for a listed company?
It depends whether they're locked up or not. There are situations where we're locked up, but in general, I'd say, if you got to have, let's work backwards, right? Let's say you invested $10 or $20 million and you own 20% of the company at some stage. Most of these companies go public, and we have seen many private equity-backed companies go public and have a market cap of 100 million or something like that. And let's say you had come in, half the price a couple of years ago. You will have to see these companies get to $300-400 million of market cap before you can see the liquidity they'll seek. So that could be 3-4 years. You should be ready for it.
Anything to add to that?
The short answer to that, I mean, both of them have spoken a bit on this, would be, liquidity. Can you actually exit if you've got a large enough stake? Stability while exiting. From some of our past funds, we've had IPO events where we've had to exit, and we've had to wait from anywhere from 6 to 18 months. And I think the lockup is a very important issue as well. So,
Okay, well, maybe if we just touch on a different type of exit, and that's secondary buyouts, and something which we've begun to see more of in the sort of Indian PE context of late. These can particularly, these can be win-win. So if particularly you have a sort of smaller domestic fund, perhaps selling to an international fund. But I mean, these types of deals also, face a lot of criticism, and a lot of the criticism directed at the private equity industry is that these deals are pass the parcel deals, and they're good for the GPs and good for the intermediaries and anyone else collecting fees. But are these really deals good for industry, good for the underlying companies, good for LPs?
we've just been through one of these deals, and maybe I can use that as an example. So we sold 21% stake we had in a logistics company to a follow-on investor who bought us out of the deal. Fact of matter is the capital profile that the company had, the kind of money they needed to grow ahead was different. They were entering new lines of businesses thanks to the successful platform they had already built. And there was going to be serious dilution, changing the kind of rights the early stage investors like us had taken. So in such a scenario, I would imagine when very large capital is coming in, large dilution is going to happen, you need to take a call. Either you're going to stay invested for another 5 years after the first 3 years you've been invested in, because the next round investor coming in is going to say, hey, I need to lock up everybody, and I don't want any exit pressures on the founder for the next 5 years till he's completed what he set out to build. So specific to this case, we have to take a call. Are the returns good enough? Were we making seriously high IRRs and X's on the investment we made? And fact of life is we were. We returned 70% of a fund through one exit, so we silly not to take some money off the table. But to come back to your general question, more specific to pass the parcel, I don't think so. I think we're all big boys. Even the guys coming in are evaluating, diligencing the deal, and they know what they're getting into. If they're buying a smaller VC investor, they're doing it for a reason. They believe in the future viability of that company and the growth that they're coming in.
Surely this should be the prevalent kind of exit.
Yeah, I think there are two factors. One is, of course, the cross-border activity as it increases. That's one trend, and we're seeing more of it for sure. The other question to ask is really how many promoters want to really sell their companies, right? So this is one issue that we constantly face. Lots of the traditional companies who are not really built to sell, they want to pass the battle. They want to take this to the next level. They have their family involved, and it's almost their identity to be running the business. So that's one challenge that we usually face, where people are not really keen to sell the entire business. So that's one of the issues. And second is I don't think the domestic buyers are paying big prices today, right? So you got to look for some of the cross-border companies which kind of see this really as a market entry, and the most kind of exits we have seen in the M&A side is probably like something like IT services, where we've seen a bunch of exits, including some for ourselves. We sold MarketRx, we sold App Labs, and some of these are to firms that want a footprint in a business or in a market.
But why is it that we don't see more domestic buyers? I mean, is it really is it the regulatory and tax environment, or is it something to do with Indian assets not having sort of the foreign trophy acquisition appeal to domestic buyers? Domestic buyers with cash prefer to shop overseas. I mean, why do we not see more domestic buyers active in this market?
Well, certainly, look, I don't have a firm view on why they aren't doing it. One thing is for sure, like most people kind of in their mind are doing the trade-off as make versus buy, and in India, I don't think there is that much appreciation for entry barriers and stuff. You believe that you can hire a good team and kind of get started, and even if you're fifth guy, put a lot of muscle to work and kind of do something. And we face that issue all the time. You think some company's special, and 3 months later there are 4 clones of the same that have sprung up, and everybody wants to do the same thing. So at least the large corporates, we've seen the behavior of let's poach this happened to us. When we go, some of our younger companies go pitch to these larger companies for business, and in those meetings we have seen the larger companies talk to the CEO and say, hey, would you come work for me, I'll pay you this much. Right? So, it happens all the time, that people think of it as something that you hire the guy and, you can run the business yourselves. You don't need to pay any premium to buy these things. So, that's one thing, I'm sure in India, we are slow to warm up to some of these risks that we want to take about acquisitions working out and, is it really going to work out or not. So, some of those as well. I think those could be some reasons.
And on the cross-border side of things, I mean, to what extent is the regulatory environment really hindering this market developing further? Until there's more certainty around the sort of the tax regulations, is this going to be a real problem for cross-border acquirers?
Yeah, it's been an issue, at least a concern, but I wouldn't say, look, at least the exits we have had, obviously it comes down to finally saying, hey, what's the tax issue around this and how do we deal with it? And when we sold Paras recently, same issue came up, but these are kind of things that you can deal with. I think if you're selling a good business and we go back and say, hey, good business is always bought, not sold, and if you're in those situations, some of these are less of concerns. But if you're trying to kind of run a process and shove a company into something else, then all these do come up as issues at that time.
Okay, thanks. Maybe then just turning back to Mukul, I guess one of the perhaps fallback exit options is selling back to the promoter, and going back to perhaps a comment made by one of the other panelists about the company being associated with the identity of the promoter. This is often a sign of a deal going wrong when you end up having to sell back to a promoter. But are there ways in which to make this actually work for you as a GP and for the promoter themselves, allowing them to perhaps gain some private equity discipline, then bring the company back into the fold?
So you're right. I think if this is the outcome, it may be a good assumption that things haven't gone according to plan. And that's one of the reasons in our term sheets, we never have a put option. Whether it's legally permitted or not, I don't want it. And the reason I don't want it is that I don't want the entrepreneur to think that this is an exit option. There are only two options, it's an IPO or a strategic sale. That's what I want the guy to believe. And the way it comes into play is a different kind of fallback, where, we are through a drag-along right, where we have the right to sell the entire business to a third party. Once the drag process is done, we run an auction, you get a price, we give the entrepreneur the option to match that price. Because the market has established a fair price. If you got the money, we don't care where the money comes from. And in that scenario, and we won, a company in the auto parts business not too far from here, in the Manasar area, we did exactly that. It wasn't our plan, it wasn't the promoter's plan. Our plan all along was to build the company to sell. We found two buyers, one domestic, one overseas. We took the best price and we were ready to go. And he got cold feet in the end. He said, I will sell my real estate and borrow money from my friends and I'll buy you out because I've worked on this for 10 years. We said, fine. And as a fallback, it works in those scenarios, and I'm okay with that. But it should not be a central, exit theme for any of us.
Any comments on that?
Absolutely. Agree with Mukul. In fact, we've seen two buybacks over the last 10 years in one of my previous funds, where the promoters bought us back, and the drivers were exactly the same. In one particular case, the exit was not going to be a listing, markets were down, fund life is coming to an end. And, it really goes back to intent eventually. If you've invested in a good management and, it really goes down to intent. Contractually, you can have a put option, you can have a buyback, you can have whatever you want in there. Eventually, what the promoter does with you is about his intent. Similarly, another business, things didn't work out. We wanted to go for a strategic sale, and the promoter said, look, give me time. Give me a year, I will buy you back, and you'll make a return. You're not going to make a seriously high IRR, but high teens, not so bad for a situation that didn't work out. So IRR in high teens with a capital protection in place, it's a good outcome for a deal that didn't work out. I would say it all goes down to intent eventually.
But, with put options, capital protection, IRR guarantees, do you actually make those work for you, or are those just starting points to negotiate with the promoter?
I would say it's usually, it's a mix of both. You can't really, there's no one-size-fits-all solution where you go and put a put option in there and say, hey, I'm going to hold you ransom with this. You have to work with Indian promoters. Indian promoters are a different animal, and each one of them is different from the other. So you have to work with these guys.
Yeah, I'd say, look, it's really hard to take money out of anybody's pocket, so you've got to work in a collaborative manner in a way that they're happy to give you those exits. If things were gone really well, hopefully this was an IPO, and that's usually the Indian promoter's primary dream. He wants to take the company public. Things didn't work out. Would he sell? Sometimes. I'm glad Mukul got an opportunity to kind of get him to match the price, but most often, look, you got to work with them in a way that is not conflicting with them. It's just, you can't do that in India.
I was trying to say is alignment of interest. It goes back to the beginning of this conversation. How well can you align yourself with the promoter and his returns profile? If you know upfront while going in that this is a guy who's trying to build an empire for himself, it would be silly to assume you'd ever have a buyback or a put option that could ever work. It really boils down to your diligence and how well you know him while going in itself.
I think what we'll do now is open up the questions to the floor. All right, well, if there are no questions, then I'd just like to thank my panelists for engaging in this topic today, and thanks again to VC Circle for allowing us to address it. Thank you.
Thank you.